Part D. The Kenlim Limited is contemplating retiring a 50 million shillings of a 30-year 1,000 shillings face value bond issued 5 years ago with a coupon interest of 9%. The bonds have a call price of 1,090 shillings and initially netted proceeds of 48.5 million due to a discount of 30 shillings per bond. The initial flotation cost was 400,000 shillings. The company intends to issue a 50 million 25-year 1,000 shillings face value bonds with a 7% coupon interest to raise funds for retiring the old bonds. The flotation costs on the new issue are estimated to be 450,000 shillings. The tax rate is 30%. The company will have a 2-month period of overlapping interest when it retires the old bonds required. Using net present value approach, advise the management of Kemlim Limited on whether the bond should be retired. Advise the company whether the bond should be retired. So candidates, here we have information in regard to 2 bonds. There is one that was issued 5 years ago. We've been given the details. It was a 50 million 30-year 1,000 face value bond. It was issued 5 years ago with a coupon rate of 9%. And the bonds have a call price of 1,090 shillings. Consider there is a premium because the face value is 1,000 and the call price is 1,090 shillings. And initially netted proceeds of 48.5 million due to a discount of 30 shillings per bond. So it was issued at a discount, and the proceeds that were raised amounted to 48 million shillings. The initial flotation cost was 400,000 shillings. That is the information we have for the old bond. The company intends to issue a 50 million 25-year 1,000 shillings face value bonds with 7% coupon interest in order to raise funds for retiring the old bond. So the company wants to retire the old bond by issuing a new bond. All right? It intends to issue. That is a new bond. Now, the flotation cost on the new issue is estimated to be 450,000 shillings. And we can see the initial flotation cost was 400. This one is up by 50,000 shillings. The tax rate is 30%, and the company we read here will have a 2-month period of overlapping interest. That overlapping interest will form part of the initial investment. There is an overlapping interest of 2 months that is when it retires the old bond. So that is a cost. Do you understand? Now, in order to advise this company, we ought to calculate the net present value. So let's first put down the formula. This is part D. The net present value, we all know by this time that is a difference between present value cash inflows minus the present value of cash outflows. That is the general formula for net present value. To get the present value here, candidates, we are going to calculate the present value of cash inflows, and these inflows will constitute the annuity. It's going to be an annuity which will multiply with a factor, present value interest factor. We are going to multiply the present value annuity factor, not interest, but annuity factor, present value annuity factor with the inflows, which we do not have, and this present value annuity factor at R% N times this annuity which you are going to calculate. This will constitute the cash inflow minus the initial capital. The cash outflow is the initial capital. The initial capital or initial investment. Let me call it investment. Initial investment. So here we're going to have the present value annuity factor. What will be the present value annuity factor? Now, what will be the rate? Now, from this question, candidates, we read that the company intends to issue a 50 million, 25-year, 1,000 face value bonds with a 7% coupon rate. Now, this 7% coupon rate will be our discounting factor. The 7% will be the discounting factor after deducting the tax of 30%. You understand? The cost of debt, KD, will be equal to the 7% times 1 minus T, which is equal to 7% times the tax is 30%, so it will be 70% times 70. This will be 70. The tax is 30%, so 1 minus 30, this will be equal to 0.7. 1 minus T, 100 minus T is equivalent to 0%. You understand, candidates? This is after tax cost of debt. The after tax cost of debt will be our discounting factor here. This is 4.9%. 4.9% will be the discounting factor here for 25 years. That will be 25 years. So, candidates, putting down the formula. Now that the discounting factor is in form of a decimal, it is not possible to read from the tables. So we are going to use the present value annuity factor formula, which is 1 minus 1 over 1 plus R raised to N. Divide this by R. Times annuity minus initial investment. And I've said that the discounting factor or the discounting rate is 4.9. So this will be equal to 1 minus 1 over this is 0, 0. This will be 1.049. All right. This will be raised to 25. It's raised to 25 over 0.49 times the annuity which we do not have minus that which we do not have. So we move on to determine the initial investment and the annuity. Initial investment and the annuity. So we're going to have workings. Let's first begin with the initial investment. Initial investment. Let's begin with initial investment. Now, the initial investment will constitute, number one, the after-tax cost of call premium. After-tax cost of premium. We'll take the after-tax cost of premium. The after-tax cost of premium, because we read that the face value was issued 5 years ago. The bonds have a call price of 10.90 and initially netted profits of 45.5 million due to a discount of 30. The initial flotation cost was 400,000. The company intends to issue 50 million, 1,000 face value bonds with 7% coupon interest to raise funds for retiring the old bond. The flotation cost on the new issue is estimated to be 450,000. The tax rate the company has at 2 million. So first of all, we'll have to calculate the after-tax cost of premium. Then we add the flotation cost of the new bond. Flotation cost of the new bond. We add the flotation cost of the new bond. We see that the new bond flotation cost will be 450. 450 will be the flotation cost, is the flotation cost of the new bond. Then we are going to also add the last sentence we read, the company will have a 2-month period of overlapping interest. We'll add the overlapping interest. Overlapping interest. The overlapping interest will be a 2-month period overlapping interest. So we will do the appropriation there for the overlapping period for the 2 months. So we are going to take the after-tax cost of premium, add the flotation cost of the new bond, we add the overlapping interest. Then we may also need to add the unamortized flotation cost of the bond. All right, the unamortized flotation cost of the bond, the unamortized, and we get the tax savings for the unamortized flotation costs. The unamortized flotation cost. We'll add the tax savings for the unamortized flotation costs, and that is we deduct the tax savings for the amortized costs candidates that will have to be deducted because it's a saving. We are calculating the initial investment. So for the tax savings for the amortized cost, we will deduct that one, the tax savings on the unamortized cost. It's a saving, so we remove it from the initial investment. You understand? The tax savings from unamortized flotation costs. Then looking at the question again, we also have the tax savings from unamortized discount on the bond. Unamortized discount from the bond. Apart from the tax savings for the unamortized flotation cost, we also have the tax savings for the discount of the old bond. Let me be specific. Old bond. Because it's also a saving, these are tax savings on the unamortized discount from the old bond. Because it's a saving, we will deduct it. So these ones, candidates, will require some workings. I had to just put down the formula to help you understand how to determine the initial investment, which will help us in calculating the net present value. The net present value. So let us have the workings. We will first work out the after-tax cost of premium. The after-tax cost of premium. Before we deduct the tax, we need to determine the premium, the call premium before tax. Call premium before tax. What is the call premium before tax? Now look at the first sentence. We read that the face value is 1,000 shillings. The face value is 1,000 shillings. In the second sentence we read the bonds have a call price of 10.90. So the premium there will be the 10.90 minus 1,000. So we have a premium of 90, that is per bond. The premium per bond 90. 1,090 minus 1,000, that is the premium per bond. Then we multiply with the number of bonds. The number of bonds. Here we read that the company is contemplating retiring 50 million. So 50 million is the par value. This is the total par value. When we divide this by the par value of a bond of 1,000, this will give us the number of bonds. All right. So we have 90 times 50, 90 shillings times 50,000 bonds. 50,000 bonds. This will give us the premium before tax. And 90 times 50, this is 45. This is just 4.5 million. So 4.5 million is the call premium before tax. Then we deduct the tax. The tax is 30%. To be 30% times the 4.5 million. 30% times the 4.5 million is 13. 1 million. This is 1,350,000 minus 4,500 is 31,50. So this is the after-tax cost of premium. 3,150,000. This one is equal to 3,150,000. That is the after-tax cost of premium. After-tax cost of premium is 3,150,000. Then what is the flotation cost of the new bond? Flotation cost of the new bond. We'll have a working flotation cost of the new bond. what is the flotation cost of the new bond. Now, flotation cost of the new bond is the third last sentence reads, the flotation cost on the new issue is estimated to be 450. That does not need any calculation, just 450,000 is the flotation cost of the new bond. 400 is estimated to be 450,000. 450,000. Then we have the overlapping interest. Overlapping interest. This one is just 450. How about overlapping interest? What is the overlapping interest? Overlapping interest. So we need to calculate the overlapping interest first of all before tax. What is the overlapping interest before tax? The overlapping interest before tax. And interest is calculated on the par value. We read in the last question that the company will have a 2-month period of overlapping interest when it retires the old bonds. That means that there is interest that will be paid after retiring the new bonds, after retiring the old bonds, and the old bonds interest is 9%. Is 9%. Is what? 9%. So the interest, overlapping interest before tax will be 9% times 2/12 times the 50 million. That will give us the overlapping interest before tax. That will be equal to, this gives me 750,000. That is the overlapping interest before tax. That is overlapping interest before tax. Then the tax, remove the tax of 30%. That is 30% of 750 times 30% is equal to 225,000. So overlapping interest after tax, we deduct this from that. It's 525,000. So 525,000 is the overlapping interest after tax. The overlapping interest, let me put after tax, is equal to 525,000. Let's move on to calculate tax savings for the amortized flotation costs. Tax savings for the unamortized. Tax savings for the unamortized flotation costs. So tax savings, as I explained earlier, candidates, this is a saving, so it's going to reduce the initial investment. This is a tax saving from the unamortized flotation cost of the old bond. The old bond. So what is before we calculate the tax savings, we need to determine first of all the unamortized cost. The unamortized cost. What is the unamortized cost? The unamortized cost. We read from this question that the old bond is a 30-year bond. It's a 30-year bond, and it was issued 5 years ago, and the company intends to retire it 5 years ago. So the period we are talking about being unamortized is a period of 30 minus 5 years. 30 minus 5 years. That is the unamortized flotation cost. We know the flotation cost, reading again from the question, the initial flotation cost was 400,000. 400,000. This, we are talking about the flotation cost of the old bond. flotation cost of the old bond. It's 400,000. Part of this 400,000, since the company intends to retire this old bond after 5 years, the bond's maturity period is 30 years. So we have 30 minus 5, which is equal to 25 years. So we're going to appropriate. All right? 30 minus 5 is the unamortized period. So it will be 400,000 times 25 over 30. Is that clear? Put it another way, candidates. These are 30 years. The 30 years is expected to cover, or the 400,000 is expected to cover the 30 years. How about 25, the unamortized? The unamortized will be equal to 25 over 30 times the 400,000. That's what I have done here. This will give us the unamortized flotation cost for the old bond. Do you understand? So the amount we get here, candidates, we need to multiply by the 30%. That will give us the saving. All right? That will give us the savings. This is equal to 100,000. 100,000 is the tax saving. This will give us the unamortized flotation cost multiplied by 30 to get the tax saving. So the tax savings on the unamortized flotation cost from the old bond is equal to 100,000. So we deduct. Then moving on to the tax savings on the unamortized discount, the same logic we'll use here. Discount, unamortized discount, unamortized discount, unamortized discount. First of all, we calculate the discount. And it's quite simple. The par value is 50 million. The company is contemplating retiring 50 million. That is the old bond. What was the discount on the old bond? The discount on this old bond will be this par value minus the amount that was received. In sentence number 2, we read that initially netted proceeds of 48.5 million. So the discount is 50 million minus 48.5 million. That will be the discount. But we will see that this company is retiring this old bond. And therefore, it is retiring this old bond after 5 years. So the unamortized discount on this old bond will be the total discount times 25 over 30. Because the 1.5 million only relates to the 30 years. 1.5 million. How about the unamortized period? Only 5 years have been amortized. How about the 25, the remaining 25? This bond is being retired after 5 years, which means 25 years discount has not been amortized. So therefore, we are going to take the 25 over 30 times the 1.5. That's what I've done here. This is 1.5 million times this. So this will give us the unamortized discount. Now out of this unamortized discount, we need to get the tax savings. What is the tax saving? We multiply by 30% to get the tax saving. We're going to multiply this by 30% to allow us determine the tax saving. which will be equal to, this is equal to 375,000. This is the tax saving on the unamortized discount, 375. We deduct. These are savings. So we can now be able to determine the initial investment. We'll add all this, then deduct the 2. It's equal to 3650. This is the initial investment. So our initial investment here is 3,650,000. We'll then move on to calculate the annuity. The total annuity, we discount it. We will have present value cash inflows. We deduct it from the initial investment. That will give us the NPV. So let us now calculate the inflows. This is the total outflow, the initial investment. We will have a workings. We have workings here. Are you following? We want to calculate the cash inflows. And to calculate the cash inflows, we get the difference between the annual cash flow savings on the old bond. We deduct the annual cash flow savings on the new bond. That is to say that the cash inflows will be the difference between the annual cash flows from the old bond. Annual cash flows from the old bond. We deduct the annual cash flows from the new bond. The annual cash flows from the old bond minus the annual cash flows from the new bond. And these are just savings. What are the savings? All right, annual cash or cash flow. And so the 2 will give us the savings, which we then deduct from the initial investment. Do you understand? Now let's go back to the question. And we are going to pick information on the old bond. We read that the bond has a face value of 1,000 shillings with a coupon interest of 9%. The bonds have a call price of 1,090 shillings and initially netted proceeds 48. And there was a discount due to a discount of 30 shillings per bond. Now, candidates, to determine the annual cash flow savings from the old bond, we will first take the interest cost. We calculate the interest cost. Then we deduct the amortized, the tax savings on amortized discounts, tax savings on amortized discount. This is a saving we deduct. You understand? That cost, we remove the savings on the tax savings on amortized discount. Then there is also the tax savings on the amortized flotation costs. we deduct. That will give us the annual cash flow saving from the old bond. We'll first of all calculate the interest cost. We deduct the tax savings on the amortized discount. Then we deduct the tax savings on the amortized flotation cost. That will give us the net annual after-tax debt payment on the old bond. It will give us the annual tax debt payment on old bond. So let us work out the interest cost. The interest cost. Interest before tax. The interest before tax, the old bond, is 9% times the 50 million. That is the interest before tax. The interest is 9%, the coupon interest is 9%, and the par value is 50 million for the old bond. 9% times 50 million. This is equal to 4.5 million. 4.5 million is the interest before tax. Then we deduct the tax of 30% times 4.5 million. 30% times 4.5 million is 1350 minus 4500 is 3150. 3,150,000 is the after-tax interest cost. That is the after-tax interest cost. This is after-tax. 3,150,000. That is the after-tax interest cost. Then we deduct the tax savings on amortized discount. This is the annual tax savings. The annual tax savings on amortized discount. The amortized discount. So what is the discount? The discount, before we apply the tax of 30%, we need to calculate the discount, and we had done it here. The discount was 1.5 million. That is the 50 million minus 48.5 million. That is the discount. That is the total discount, 1.5 million. So this 1.5 million, because we are calculating the annual, and remember, candidates, we are looking for an annuity. So our figures here are annual figures. We are calculating the annual cash flows, the annual cash flow savings, the annual tax debt repayment. Everything here is annual, and therefore we're going to divide all this by 30. Why 30? It's because the maturity period is 30 years. So this will give us the tax savings on amortized discount. So I have, this is 15,000. It's important to note that this, we first of all calculate that, then we apply the tax. You understand? This is the tax savings on amortized discount. Annual tax saving on amortized discount. So we first calculate the discount, which is 1.5%. We divide by 30 to get the annual discount. We apply the 30% to get the annual tax savings on amortized discount, which is 15,000. This is equal to 15,000. Are you following? Yes, you are. You are following the calculations. And given that is a saving, we deduct from the interest cost after tax. Then we have tax savings on the flotation costs. Tax saving on flotation costs. We are going to use the same razor blade. We are going to use the same approach. In Swahili, they say, wembe ni ule ule. Wembe ni ule ule. There are people who interpret the same razor blade. We're going to use the same razor to calculate the tax savings on amortized flotation costs. So before we apply the tax, first of all, what is the flotation cost? The flotation cost. What is the flotation cost? The flotation cost we are given directly from the question on the old bond. The flotation cost on the old bond, the initial flotation cost was 400,000. So the flotation cost initially it was 400,000. That is the flotation cost. So we divide it by 30 to get the annual flotation cost. That will give us the annual flotation cost. Then we apply the tax rate of 30% to get the tax saving. You understand? 400 divided by 30, that is the annual flotation cost, old bond, times 0.3. It's 4,000. So 4,000 is the annual tax savings on amortized flotation costs. Deduct. We deduct. So we have 3,130,000. That 131. 131,000. That is the annual cash flow savings from the old bond. The old bond. That is old bond. Let's move on to the new bond. That was the old bond. How about the new bond? The annual cash flows from the new bond. We are going to use the same formula for the new bond. So we begin with the interest cost. The interest cost will be this 7,000. The new bond, the coupon interest is 7% times 50 million. 7% times 50 million. It's 3.5 million. Then we deduct the tax. That is 30% times 3.5 million. It's 1050. So after tax, 3,500. It's 2,450. To 24,450. That is after tax. Debt payment. Annual after tax. After tax debt payment is 2,450. 2,450. Under the new bond, there is no discount, but we have the tax savings on amortized flotation costs. amortized flotation cost. You have the a tax saving on the amortized flotation cost. So what is the tax saving? First of all, we know the flotation cost for the new bond is 450,000. It's 450,000. And the maturity here is 30 minus 5 years. This new bond is being issued after 5 years up to the maturity. So it's equal to 25 years. 30 minus 5 years. That will give us, this one will be annual amortization cost. We apply the 30% to give us the tax saving. So we're going to divide 4.5 by 25, then times 0.3, 54,000. So 54,000 we deduct from that. That will give us the answer there. $2.44,600. So that is the annual cash flows from the new bond. We've calculated the one for the old, and these were workings, so just workings. So the answer here, candidates, will be the annual tax debt payment on old bond, which is 31 minus 24,600. This will give us the savings, which is equal to 686,400. 686 is the saving, which we need to come and plug here, plug in. That is the annuity. The annuity is 686,400. That is the annuity. Then we discount it. All right? We had already determined the initial investment. The initial investment, we have it. We don't need this working anymore. So to calculate NPV, we needed two things: the present value cash inflows minus the present value cash outflows. And we have calculated both the cash inflows and the cash outflows. So the answer here will be the present value of this annuity. And we are using this present value annuity factor formula at 4.9%, 25 years. So we discount this annuity, we deduct from the initial investment. That will give us the NPV. That is going to give us the NPV here. Now, candidates, the NPV is positive. That is 6,121,792. That is the NPV. What was the question? Using NPV approach, advise the management on whether the bond should be retired. And the answer is the proposed retirement is recommended. The proposed retirement is recommended. Why is it recommended? It's recommended because the NPV of retirement of the bond because the NPV of retirement of the bond is positive. The proposed retirement is recommended because the NPV of the retirement of the bond is positive. So thank you for attending the lesson. That is how to solve such a question. And I've been telling you all along, if you have a question like this one, step is to put down the formula. Beginning from this is C Roman 1, we began by putting down the formula. Roman 2, we put down the formula, then calculated it. In D, that is the NPV formula. NPV formula, you put down the formula, then you work out the inputs. NPV has two inputs. That is the present value cash inflows minus the present value cash outflows. And we have seen that this is a positive NPV. Positive NPV. So the proposed retirement is recommended because the NPV of retirement of the bond is positive. These are how many marks? These are 10 marks. 10 marks. Candidates were required to show workings. It's important to show all these workings. All these workings, important to show the workings. 10 marks. Thank you for attending the class. Make sure you practice. Look for similar questions and do them. In case you will be unable to do the questions, just write to us. We'll help you solve the questions. We've solved all past paper questions for the fixed income investment analysis, just like the other subjects. If you have any question, any burning question, if you are attempting past paper questions and there is any of the questions that you are unable to find solutions, please inform us and we'll help you as you prepare for your exams. Bye-bye.